In this video, we're going to discuss manufacturing variance when we are using standard costs. Now, variance is really important topic when dealing with standard costs because it basically is going to tell us the difference between what we thought the product should cost versus what we actually produced a product for. And the reason why it's so much more important in standard costs is that we're just going to record the cost based on the standard price that we calculated, as opposed to having the system calculated on some average cost or first in, first out method. So there's extra work that needs to be completed at the end of a period in order for us to accurately display all of our financial data inside of our financial reports, such as our balance sheet and profit and loss statement. Now, this process is going to be quite involved, but manufacturing variance is an involved topic. So let's get started. I have a couple of products that I've created. I have a manufactured product with standard cost and two raw materials, raw material 1 in standard cost and raw material 2 with standard cost. Manufactured product, we have the cost set to $165, and let me just search for standard here. So we're going to look at raw material 1, which is $20, and raw material 2, which is $25. And that's going to give us a product that costs $165. We computed this price from the bill of material. And if we go to the bill of material, we'll see we're using two raw material 1, two raw material 2, and we have one operation for 30 minutes. And this work center's estimated cost, if we click on the work center here, is going to be $100 per hour and $50 per hour for employee costs. So what we have essentially is $50 for our overhead and $25 for our employee costs, $75 total operations and labor. And if we went to our bill of material overview, we can see a breakdown of that. We see our product costs, 40 and 50, which is 90, and our overhead or operations cost, which is 75, for a total value of 165. So that's going to be our standard costs. Now, when we manufacture this product, there might be a variance associated with either the labor, the overhead, or the material. So when we have a variance, we need to account for that, and we need to know that there's a variance. So in this video, that's exactly what we're going to look at, and then we're going to look at the journal entries that need to happen. Of course, we're going to go through just one example, but this will be done on a much larger scale, and that's totally fine. Now let's go into manufacturing. We're going to create a new manufacturing order for our standard manufacturing product, and we'll simply confirm this. Now, I don't have any of my raw materials in stock, so let's go ahead and just quickly purchase them. I'm going to purchase them from vendor 1, and we're going to take our raw material 1 and raw material 2, and we'll purchase, for the sake of this demo, we'll just purchase 10 units of each, receive those products in, validate our receipt, and create a bill. Let's not forget to set that bill date and confirm. All right, so now we have the products in stock. We can begin the manufacturing process. So on the shop floor here, I have my new manufacturing order number 4 for our standard cost product. I'm just going to simply record some time against this, as we've seen in previous videos, to start tracking some time against our production. Now I'm just going to stop my time tracking, and I'm going to go into the back end in my manufacturing order. I'm going to manually adjust this to set this to a different time for our labor. So I'm going to open up this wizard here, and I'm just going to adjust the time here. So I'm going to say that this took us an hour instead of 30 minutes. So let's just do 2100 or 21. I'll do 22 here. So now this took a total of 60 minutes. So we have an unfavorable overhead cost as well as an unfavorable labor cost. All right. So now what we're going to do is simply produce all, and we're going to look at the journal entries that get created. Now, if I go to my valuation here, we're going to see that a $165 value was created for our manufactured standard product. whereas we've just pulled $90 worth of raw material, and then we have $75 left for our overhead and labor. Now, if we go to our overview here, we actually see that the cost to produce these goods was much higher. It was actually $265. So there's a variance there that we need to account for. All right, so let's go to our accounting app, and let's go and look at our balance sheet. And as we suspected, our cost of production, $75 here. And that's because we're using standard cost. So we didn't account for any of the extra variance. We just had extra variance, and it is what it is. But we're going to do some manual journal entries later on. Now, the next thing we need to do is, just like we've done before in our previous video, is that we need to move this cost of production into their appropriate accounts, because we need to offset any of the labor and overhead, our standard labor and overhead, that is. So let's do that first, and then we'll take a look at some of the variance. Okay, so let's go into accounting. We'll create a manual journal entry, and I'm going to create and open a new tab here. And we need to pull in our costs. Now, in our previous video, we've seen how we can look at our production analysis, and we looked at how we can pull in all of the different reports that we need, our work entries specifically. And we can also look at our production analysis, our inventory report, and that is all going to get us the values that we need when we're dealing with a lot of products. But right now we just have one product, so we can just get that information from our manufacturing order, which is going to be manufacturing order number 4 here. And I'm going to pull that information from our overview, or rather we're going to pull it from our bill of material, because we're using standard cost. So we should have had $50 for overhead and $25 for labor costs. So I'm simply going to make a journal entry, and it's going to be our cost of production account. We're going to debit that for the total 75, and then we're going to offset it, or offset our salary expenses, because we're counting that now as an asset, for $25, and our overhead, which in our previous example we just simply said that the overhead was electric, which obviously is not realistic, but we're just going to do that for this example. So now we're simply going to post this, and now if we go to our balance sheet, our cost of production account is zeroed out. We have that standard price manufactured product accounted inside of our stock valuation. Automatically, that happens by the system. So we increase the stock valuation by the standard cost. So if I go to my general ledger here and we scroll down, we see $165 worth of value was added to our stock valuation for our standard price product. And we offset our payroll and our overhead account for the remaining balance in that cost of production account. So that's all good so far. But as you know, there was a variance to our manufacturing process. We spent a lot more time in our overhead, rather for our overhead and our labor, so we need to account for that. We need to account for that simply, one, for knowing that there's a variance, and maybe we need to adjust our standard price to reflect that if it's something that's happening all the time. Or we just need to simply create a journal entry so that we can account for that accurately on our profit and loss statement, so we know what our actual salary costs were and what our labor variance might have been, as well as our overhead variance. So now I'm going to go and look at our manufacturing report. Under reporting, we'll look at our production analysis. We're going to go to our pivot table view here, and I'm just going to remove some of these views, because what we care about is our total employee cost, total operation cost, and as well as our total component cost. And what I'm going to do here is group this by product. Right now, we are particularly interested in our manufactured standard product. And if we want to, we can pull in the total cost here as well. And I do want to see our quantity produced, because we're going to need that as well. So with this information, we can calculate out our standard costs with some work that we can do inside of our Odoo spreadsheets. So I'm going to insert this into a spreadsheet that I've already created, and we're going to look at how we can calculate our standard cost. So I'm going to insert this into a spreadsheet, in my manufacturing variances spreadsheet here. And we're not going to do anything with it yet. I'm going to go to sheet 1 here, and all I did was add in some different variables that we're going to keep track of. So we have our product. We need our product ID and the name of the product just for reference purposes. We're going to need to manually enter our standard costs. Typically, you would either store this in the system with new fields, maybe using Studio that we can reference, or you might just have them on a spreadsheet of how you originally calculated these items. So here, what I'm going to do is just write them in, but then we're going to calculate the actual costs based on our pivot table and our total variances based on what the standard cost was and our actual costs. So the first thing I'm going to do is enter in our products. So what we'll do in a real world scenario is keep track of all of our product IDs that we're producing with standard costs. So, and then we're going to keep track of those standard costs, and we need to break them out by overhead, labor, and material because we need to compare them for each option. So the first thing I'm going to do is go into another tab here, and I'm going to just pull in my material costs, which should be $90. I'm going to pull in my overhead costs, which should be $20 or $50, and my labor costs, which should be $25. And I'm just going to make all of these currencies. Let's go to number, and we'll go to currency. Okay, we need the product ID, and we can get that product ID from going to our product. We're going to go to our manufactured standard cost product, and we can either look, we're going to take the URL. At the top of the URL, we're going to see that's ID 23. I know you can't see it on the screen, but it is in your URL, or you can use Studio to bring the ID onto our product if that's something you want to do. So if we wanted to, we can go here and we can search for ID, or it might be already on this if we can't search for it here. So if we show invisible items, it will be here somewhere. There we can, here we have our ID here, which is 23. We can make this invisible so that we can see the product ID, which is 23. All right, so we have our product ID. Let's go back to our other tab. We're just going to write it in here, and we can do our sum. The total cost for our product, our standard product, is $165. We have the ID, which is 23, and let's just copy and paste in our name as well, just for reference purposes, but we don't necessarily need that. All right, so the next thing we're going to do, let me just adjust this so we can see it all on one screen. Okay, so the next thing we need to do is pull in the actual costs. So our actual cost is actually in this table we have here. But the benefit of using Odoo Sheets here is that we can reference all of our products and our variables without having to manually add them every time. So what I mean by that, if I hover over our total employee cost for our manufactured standard product, we'll see that this is Odoo pivot, Odoo.pivot, which is a formula pulled in for this sheet, the ID of the pivot table, which is 1 because it's the first one that we entered. The field that we're looking at, the measured name, is employee cost. We're looking at product ID, number 23. So that's the domain set. So the product ID is 23, and we're looking at employee cost. So we can simply copy this over, and for our labor here, we can paste this in. But we can even do more than that. We can replace the ID here with this ID, so that if I drag this down and I have additional products here with just the ID, it will reference them without having to, you don't have to reinsert this into the pivot table. This doesn't even have to be in here anymore. We can delete it. As long as we have originally entered this into this spreadsheet, we can reference those variables, which is really helpful. All right, so we'll just leave it like that. We have before referencing here. We have our employee cost, and we're looking at product ID. So the next one here is operation cost. So I can just take this formula, I can go to overhead, and I can replace this with operation cost, which is $100. And last, we need material, which is referenced as component cost. So we'll just paste this in, and we'll do component cost. So there's a lot of setup here, but once we have this all set up, we can easily reference it. The last one, again, is going to be our quantity produced. So let's go here because we're going to need this to calculate our variance. We'll do quantity produced. All right. Oops. So I adjusted the wrong one. Let's do, what we need to do is quantity produced. Making sure I have all those accurate. Okay, and this should not be a value. We're going to change this to a number. All right, so we have everything that we need so far. The next thing we need to do is just calculate the variance, and we're going to do that just with some simple formulas. We can also reference the total here, the total cost if we want to. So let me go back here. I'll copy this over and change this to total cost. Okay, so now we just need to do some Excel work, some formula spreadsheet work in order to calculate our total variances over here. We need to be careful. We need to make sure that we calculate the overhead based on the number of units produced. So we care about the total overhead for our manufactured product. We care about the total labor overhead. It doesn't necessarily matter for this particular use case how many units we produce, but we need to keep that in mind for our division and our comparison to the standard labor costs. So let's do that now. Our overhead is going to be equal to our overhead value here, which is the total value divided by the number of units, which is still $100, of course, for this example, but we need to compare it to what it should be. So if it's our overhead here, which is what the overhead should be, multiplied by the number of units, and that's going to give us an unfavorable variance of $50. And we can actually reverse this, so we can make sure that that's negative, and unfavorable variance of $50 for our overhead. We simply do the same thing for our labor and material. So for our labor here, we're going to again do the same formula. We're just going to change this around a bit. So instead of overhead here, we're going to calculate from labor, which is going to be J. And then for our labor on this, we're going to change it to E. And we have an unfavorable variance again of $50. Now you might be confused by this, right? Because we have $75 here, but we only track 30 minutes. And the reason why is that in our previous video, we've seen that the estimated labor cost from our overhead or from our work center is used in our standard cost calculation, but the actual labor cost from our employee profile is used when I'm tracking time. So 1 hour of the time that I tracked was actually worth $75 as opposed to the $50 that we put on the standard cost average hourly rate. So this is an accurate labor cost. So we have a -50 overhead and a -50 labor, which is exactly what we should have. And then once again, we're going to update this one and we're going to do our material. So let's go ahead and change this. So our overhead here should be material. So we're going to do K4. And then for our standard cost, we're going to pull from F4. And we have a $0 material variance. And then we can calculate the total variance for our particular product. That might just be useful to understand our total variance. So we can do total variance. We can just add up these three columns here if we wanted to. And we have a total variance of -$100 compared to what it should be, which is $165. Perfect. All right, so now we have the values we need. And every time we manufacture new or different products, all we have to do is write this in. So we're going to put the product ID and the overhead, labor, material costs, and the rest of this will be calculated for us. We can just drag this down. And right now there's an error because we don't have any values. But in the future, when we have values, or we can do if error an Excel formula to make this 0 and drag them all down and wait for new products to be added. And this will automatically get filled in. So I'm just going to undo that. But you can see that just by setting this up, leaving it like this, we'll have all the values we need going into the future. If we wanted to calculate our percent change, we can do so by adding another formula that I have copied here. And basically what we're going to have is our overhead, or rather our overhead variance divided by the number of units produced times the standard cost. So I'm just going to change this to 4. And we can drag that down if needed. So we see our percent change is negative $100. And I'm using some conditional formatting here under our conditional formatting in order to calculate this the way we want. And that just makes it a little bit nicer to view, but it's not necessary. And basically, we don't really need these changes if we don't want. We really just care about the total values, but it is nice to see in a visual way what our variance looks like. All right, so I'm just going to delete this row as well. And now we have our total variance. But there's one thing to note here. What we can do is have this save for us, and our variance we care about at the end of a period, maybe a month or a quarter, when we want to calculate our variances. And we can just have this same spreadsheet, and this will update based on some formula that we can add in, or a filter rather. And we're going to have a new filter here for date, and we're going to say that we're going to month or quarter, whatever we want, time range. What we're going to add here is the end date, and we'll save this. And now what we can do is search at the top of our screen for a particular month or year. Let's say we want to do this for Q4. There's nothing in Q4 for 2024. But if we change this to Q1, we see all of our data upload or update. So we can make this one time and use it for the duration of, forever, right? So we don't need to do this every time. All we need to do is add in our products with their standard costs. And as we update standard costs, we need to make sure that we update this. And then all of our actual and variances will automatically populate. However, we might need to drag this down once in a while so that we can fulfill all of the new standard cost products that we produce. So now that we have those values, what we might want to do as well is I'm going to insert a new row above. Actually, let's undo that. We'll insert one row below, and I'll just make these a little bit bigger. And for the sake of making this look nice, let's go ahead and hide our grid lines. And what I'm going to do now is insert a new chart. And this chart is going to reference our total variance. So we can add a couple new fields here, maybe some hidden fields, or we'll just do it right here on the side, and we'll do sum of our total overhead, and we'll do sum of our labor, and we'll do sum of our material, right? And I'm just doing this a little bit sloppy, but we get the point here. What we're going to do is create a gauge, or rather not a gauge, a scorecard. And the scorecard is going to have this value from C1. And we'll say that we'll design this, and we'll say that this is incorrect here. Let's do sum. This is going to be the overhead variance. And we'll do the same thing for the rest of them. So we have this overhead variance. And we can make a new chart here for the overhead variance, for the labor variance, and for our variance for our material. So basically what we'll have is these charts at the top of our screen to quickly show us all of our different variances. So if we want to just continue on and make the next two, we can certainly do that. So we'll insert a new chart, and we're going to do a scorecard. And we're going to set this key value to this. and we'll remove that. And this is going to be our labor variance. And we can add that to our top. And lastly, what we'll do is insert one more chart. And this time we're going to do another scorecard. And this value is going to be here. And we're going to do our material variance. All right. So now, each month or each period that we want to calculate this, we're going to see our overhead variance, our labor variance, and our material variance always calculate here based on the filter that we have set at the top of our screen in this filter. And then we can take these values to make their appropriate journal entries. Now, the appropriate journal entries will change or will depend based on the way you use your standard cost and the GL accounts that you have. Now, we already cleared out our cost of production with the standard cost, but there's still some actual costs that went into making those products that we need to account for. Now, there's two different things that we can possibly do. If we have a favorable or unfavorable variance, it might just be some one-off, and maybe we calculate it and put it on our profit and loss statement as, we can do it as labor efficiency account that we might have set up. Or we might need to revalue our inventory and our standard cost. So we might need to change the cost of our standard of our products if this is going to be a change that will keep happening. For example, if we miscalculated the time it should take to produce a good, or if the material price went up, or we need to use more material than we typically would have or we thought we would have, then we should probably update our standard cost and use this as more of an asset, right? We're going to add value to our products. Or there can just be one-off scenarios and we need to account for them on our profit and loss statement as expenses, which they already are, but we want to differentiate between what we thought the product should cost and our variance. So for example, we can take our labor variance here, $50, and we can go ahead and create a new journal entry. And inside of my chart of accounts here, I have some new accounts. I have my labor efficiency variance, my overhead efficiency variance, and material efficiency variance to offset some of the costs that I have on my expense inside my profit and loss statement. So I might have salary expenses, maybe that's $5,000, but $250 of that was actually labor efficiency variances that we want to account for. So what we can do is create a new journal entry, and we will simply, our labor account will debit it for our $50, and our salary account will credit for $50 at the end of our period, post this, and then on our profit and loss statement, we will see that we have some salary expenses, but we also have our labor efficiency variance here, just to show that yes, we had salary expenses, but those were variances inside of our manufacturing process, and they typically shouldn't occur. So it's an important distinction to show this on your profit and loss statement if you want to, of course, or if your guidelines or your accounting guidelines suggest that you should do so. That's totally up to you, but I just want to show you the different journal entries that would be created. Now, I would do the same thing for my other materials as well as my overhead to account for that as well. So we went over quite a bit in this video. Just to recap, we went through the manufacturing process with standard cost. We remove that with standard cost. We see that what we accounted for was simply the standard cost of the product, and what was left in our cost of production account was the standard cost for our operations and labor. And then we moved that from our cost of production account to offset our salary and overhead based on the standard price. Then we had to account for variance. And in order to do that, we used our production analysis report. We inserted it into a spreadsheet. And inside that spreadsheet, we were able to calculate by month or quarter our variances for our overhead, labor, and material. And then we use these values to make sure that we accurately display our expenses on our profit and loss statement.